What's up, everybody? My name is Joe Brown. This is the Heresy Financial Show, and today we are talking about the yield curve because it has finally inverted and it stuck this time. It inverted a while ago and then it flipped right back, but now that it has inverted and it's stuck, it is time to talk about it because it's real this time. It is flashing a recession warning, so I'm going to explain very simply what the yield curve is, what it means when it inverts, why it inverts, and why it means a recession is likely on the way. Ready? Let's dive in. All right, as of the time of this recording, the United States 2-year Treasury is currently sitting at 3.09%. At the same time, the 10-year Treasury is sitting at 2.995%. And just in case you failed high school math, 2.99% is indeed lower than 3.09. And yes, I think that probably is the state of high school math in America today. Anyway, the yield on the 2-year is higher than the yield on the 10-year. This is called an inverted yield curve, as opposed to a normal yield curve. Normally, the longer the maturity on the bond, the higher the interest rate. It's called a yield curve because if we chart out the bonds, the maturities and the interest rates, normally what you would see is a chart that looks like that. You'd have the 2-year down here, the 10-year here, the 30-year here. As you go out this curve, your interest rate would get higher and higher and higher. Now, think about this logically and personally really quickly here. If you're gonna loan somebody money for a year and you say, yeah, just give me 1%. So take $100, give me $101 back. All right, fine. But now what if you're gonna lend somebody money for 10 years? If you lend somebody money for 10 years, you probably want a little bit more than 1% because number one, the opportunity cost that you'll have of missing out on that money for 10 years as opposed to just 1 year. The other thing is the risk increases that something will happen to that money along the way. Like what if he dies? Or what if the business fails? Or what if whatever he's doing with the money, there's risk that he's not going to be able to pay that back. And so you want a higher interest rate to compensate you a little bit more along the way, just in case that debt defaults, something happens, you can't get it all back. You've at least collected a little bit more along the way. So that's why we're looking here. We can see that in a normal environment, interest rates will increase the further out you go in time. Now, in the environment we're in today, first of all, the yield curve is very, very flat, right? But we also see that part of it has inverted. So I'm just going to draw it like this for visual effects so that's really easy to see. But we're sitting here where the 2-year is higher than the 10-year. The 30-year is higher, so it's actually looking like this. So it's kind of a weird curve right now. But the 2 and the 10 are what investors normally look at for an inverted yield curve. That's the main indicator. And in fact, when we look at the yield curve, the 2 and the 10, it has inverted many times over the past. And if we take a look at the number of times it's predicted a recession, it's got a really good track record here. So the US curve has inverted before each recession since 1955. So the recession that has come next has happened within 6 months to 2 years. Since 1955, the yield curve has only inverted once without a recession following. So there was a false signal only one time since 1955. And then if we go back all the way to 1900, the yield curve has inverted 28 times and 22 of those a recession had followed. So in the last 122 years, there have only been 6 false signals from the yield curve inverting, predicting a recession. So what's going on here, especially recently, is not a free market phenomenon. This is an expectation of intervention. So normally we saw that the yield curve would go up, right? Because if you're expecting the longer time, more risk, you want more compensation to pay you back. But in today's environment, as we just saw, the yield curve is going down. So you might be asking, well, if we're factoring in the chance of a recession coming, well, that's even more illogical that the yield curve should be going down into the future. If you think that in between 2 years and 10 years, the odds of a recession actually go up, then you would also think that you would want a higher interest rate, right? Because if a recession's coming, you want to be compensated for that extra risk, right? Well, again, this is not a free market thing that's going on. We are factoring in the anticipation of intervention by the central bank. So we've got the 2-year, we've got the 10-year, we've got the yield curve going down, because what happens if a recession comes right here? What is the Federal Reserve likely or expected to do if we go back to 1980? If we look at the last 42 years, what is the Federal Reserve likely to do with interest rates if we get a recession right here? Well, the Federal Reserve is likely to push interest rates down to deal with the recession. And so that's why the 2-year is currently higher than the 10-year. We're factoring in the likelihood that things get so bad the Fed has to step in and force interest rates down. So this is not a free market phenomenon. This is not something that should be happening or would be happening if things were left to their own accord. In fact, with a sound money environment, with a monetary system that had a fixed supply of money where the money supply could not be expanded or contracted or money lent into existence through fractional reserve banking, in a system like that, the interest rate would over time actually approach zero because you get natural deflation over time as things get cheaper because the money supply stays the same, but the wealth grows. And so it takes less money to get the stuff. You got more abundance, but the same number of slices in the pie, basically. And so in that sort of a system, you gain purchasing power just from saving. Lending would approach very low interest rates over time because there's a real return on your money just from saving. So they probably wouldn't be 0% everywhere and always, but they would be pretty low over time. You wouldn't need these extraordinarily high interest rates in any area for lending because you wouldn't have the necessity to compensate for inflation and a loss of purchasing power over time. But that's a topic for an entirely another video. That's an explanation of the yield curve and why it's inverting now, why it means that we're likely to experience a recession soon. In my opinion, we're already in a recession, and we'll find out within the next couple of weeks when the official data numbers are in. In either case, that's what's going on here, and the market is starting to price in the anticipation of a Fed pivot at some point in the future. Thank you so much for watching. Have a great day.